Hello, and you're welcome to Global Business Insights, where you get more on the main business headlines across the globe. China's official May Manufacturing Purchasing Managers Index (PMI) dropped from 50.4 in April to 49.5 in May, missing market expectations of 50.5. This adds pressures on policymakers who want to see stronger growth as the government is expecting more activity in the high-end manufacturing sector amid a lingering property slowdown and weak consumer demand. On PMI, we also will be watching out for Nigeria's May PMI out on Monday, where we expect high inflation to continue to weigh on expansion. In the US, technology stocks pulled back yesterday as we saw the Nasdaq Composite down 1.1%. The S&P 500 also ended the day down 0.6%, while the Dow Jones average slipped 0.9%. Trump Media and Technology Group's stock fell in after-hours trading after the jury in Donald Trump's trial delivered a guilty verdict on all 34 felony charges. Higher uncertainty and risk of a political shock in the US will be compelling planners to hold back major decisions about long-term spending, even as the conviction magnifies the cloud. The conviction is not expected to materially impact sentiment when markets open later today. However, sharp policy differences between the two candidates is also driving more uncertainty and volatility. Is Africa at the cusp of a different transformation, or is it the familiar rhetoric in new skin as the African Development Bank Group unveiled its new 10-year strategy, that's 2024 to 2033, this week and launched the African Economic Outlook for 2024. The strategy document is a blueprint to confront Africa's pressing challenges and help put the continent firmly back on track towards sustained economic growth and prosperity. There is a wave of consolidation happening in the oil and gas industry. This time, Conoco has agreed to acquire Marathon Oil in an all-stock deal, valuing Marathon at about $17 billion. The acquisition will extend ConocoPhillips' reach across shale fields in Texas, North Dakota, by adding 2 billion barrels of resources to its inventory. Eurozone unemployment dropped further in April, falling by 0.1 percentage points. A strong jobs market has taken the rate to its lowest level since 1999. The euro area's unemployment rate fell to 6.4%, with just under 11 million people unemployed, down from 6.5% in March. Also yesterday, we got the second estimate of US real gross domestic product, showing expansion at an annual rate of 1.3% in the first quarter. This reading followed the 1.6% growth recorded in the first estimate and was in line somewhat with market expectations. In the US, the big data event is today's April Personal Consumption Expenditures Index, expected to rise 2.7% from the same time last year, the same as March's reading. For the month, it's expected to edge 0.3% higher. Core PCE is expected to, however, rise 2.8% for the year, also the same as March. New York Fed President John Williams said yesterday that he expects PCE price index inflation of about 2.5% this year, coming down to the target at 2% next year. Also adding that the current stance of monetary policy is restrictive enough. First, on oil markets at their meeting, OPEC Plus this weekend is likely to extend the current production curbs and address a growing volume of unused capacity in the oil market. Analysts see reductions amount to about 2 million barrels per day, also leading to a growing volume of unused capacity. Another significant event in oil markets is the formal announcement by the government of the Kingdom of Saudi Arabia and Saudi Arabian oil company Saudi Aramco of a secondary public offering of 1.545 billion ordinary shares, representing less than 1% of the company's issued shares. The offering is set to start on Sunday, June the 2nd, and it will go on till June 6th, marking a significant event in the global energy markets. Saudi Arabia is selling roughly $12 billion worth of shares in this sale as the kingdom seeks further capital for its sovereign wealth fund. According to Amin Nasser, the chief executive of Saudi Aramco, he said the timing of the sale had been decided by the government and that the offering was an opportunity for Aramco to broaden its international investor base. The Saudi government is cautiously diversifying out of fossil fuels, harvesting its equity to invest in new digital technologies in an ambitious economic diversification plan, as well as milking Aramco to fund new mega projects to fuel its economic growth. Oil prices continue to see more downside, with US markets seeing ample supply amid a weaker than previously estimated Q1 GDP print. The OPEC Plus video conferencing meeting this weekend will, apart from quotas, shed light on compliance with agreed cuts. Brent crude standard, the crude oil front month, is under $82 per barrel as we speak. It's obvious that prices can still come down as current prices include a significant risk premium, which is slowly falling as geopolitical risk calms, albeit there's still a bit of uncertainty there. EVI had predicted in January an average of Brent at $75 to $80 as demand remains capped by tepid global economic growth. The wild card being, of course, the toxic Middle East geopolitics.
One is the era of cheap money is gone, so everything it gets very expensive. Second is the structure of the debt itself has changed. We used to have before, in 2010, roughly about 57%, I would say, like that, of Africa's debt was concessional debt, bilateral debt. Today, that has gone down to 25%. But you see the opposite side has happened. You found that commercial debt, private commercial debt, Eurobond debt now dominate. It used to be 17% then. Today, we used to think they're about 45%. Now they are probably about 55%. And those things have implications. They're short-term debt, they're expensive debt. And at the same time, you find because of the huge amounts of Eurobonds that have been issued, you have bullet payments that are due. And so there's accumulative things that are there that risk our economy. So we need to find out ways to make sure we have debt resolution, debt treatment for African countries. The G20 Common Framework is a great initiative. We all know and we applaud all the efforts being done, but it's slow.
Banks and accountants typically do not play as important a role as the leaders and the entrepreneurs and visionaries. But in the 19th century, the likes of JP Morgan and the great financiers partnered with the Carnegies to build the foundation of the industrial age. Today, we are in a different digital age. The geoeconomic complexities are recalibrating capital flows, and Africa remains disadvantaged. The Bretton Woods institutions that emerged after the Second World War focused on reconstructing a war-damaged Europe. NATO emerged to ensure Europe was safer and stable for investments. The World Bank and the WTO, World Trade Organization, sought to establish rules-based trade and global financial rules, which at the time saw Africa as a terrain with rich natural resources but with hidden dangers, justifying investors' demand of higher returns and higher costs of borrowing, which continues to hurt the continent, while harvesting cheap resources, which of course further hurt Africa as limited value was added locally. Africa Development Bank Group is trying to change the narrative for Africa. Its optimist-in-chief President Akinwunmi Adesina, in his final year at the helm of affairs, says Afdb is going to be Africa's solutions bank, and is acutely aware that the next decade will be decisive in transforming the continent. Priorities include promoting access to affordable energy, ensuring food security through agricultural transformation, and catalyzing manufacturing as a critical driver of job creation, as well as fostering regional integration, all to enhance living standards. The new 10-year vision of a prosperous, inclusive, resilient, and integrated Africa is supported by solutions such as promoting good governance, investing in women and young people, climate change adaptation, supporting fragile states, and building resilience. There are a few important themes. For example, Africa is home to the world's most youthful population, with a demographic dividend arising from skilling up and harnessing a powerful potential, with many opportunities disguised as gaps. Africa is also urbanizing faster than any continent, creating vast opportunities for growth. The just released Africa Economic Report says average growth in real GDP fell to 3.1% in 2023 from 4.1% in 2022, but the forecast for 2024 to 2025 is looking promising as global economic conditions brighten. Real GDP growth is projected to rise to 3.7% in 2024 and consolidating higher at 4.3% in 2025, underscoring Africa's resilience and benefits of policies putting economies back on a higher growth trajectory. My conclusion is that beyond well-meaning aspirations, first, who succeeds Adesina in championing and leading execution as he leaves the African Development Bank, and to what extent is this vision shared and bought, and what are the clear next actions? Second, the West is presently preoccupied in a tough geopolitical context, and one can expect less support at the continental level for African causes, implying Africa and especially its leaders have to do more to speak for the continent and to solve its own problems. Third, expecting lower risk ratings for Africa simply because the Afdb says so is somewhat naive. Africa must act more decisively to de-risk its environment, and leadership needs to unite to enhance attractiveness factors. The low-hanging fruit could be the acceleration of regional integration. Soon after news that Anglo American had rejected the request for an extension of time to discuss a higher BHP offer, Anglo is already facing opposition over its plans to slash spending on a multi-billion-pound mining project in the north of England, also seen as a crucial move by Duncan Wambler, that's the CEO, to fend off a £39 billion takeover bid by BHP. Spending cuts on Anglo's £7 billion Woodsmith fertilizer mine in Whitby, North Yorkshire, as part of a package of restructuring to keep Anglo afloat as its diamond business struggles. Local people have supported this project for many years and now say it seems it's been used as a sacrificial lamb to fend off a takeover from BHP. But Anglo says slashing funds is only temporary and it will save the project in the long run, allowing time to build itself a market for the yet unproven product. Anglo said the slowdown puts it in a better position to also accelerate again as soon as they can. BHP is of course watching and may come back this year with another takeover bid as it eyes Anglo's prolific copper fields, also likely to be more surgical in its consolidation, which are somewhat similar to what Anglo is saying it aims to do. Anglo's restructuring plans, which could raise up to $25 billion, include exiting its South African platinum business and selling the diamond brand De Beers to put more focus on copper, premium iron ore, and crop nutrients. Fertilizer, Anglo says, is very clearly at the center of things, which should be a good thing, good news for Woodsmith, but others say for Anglo, this piece of their portfolio of assets remains a question mark, and the slowdown is the first stage of an imminent exit. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and for the kind comments and following or subscribing on Facebook, LinkedIn, or YouTube and X. Thank you very much for watching. Bye-bye.